Yeah, a director's loan account is a list of transactions that a director has with a company that is not its salary or reimbursement of company expenses. It's really common in a director owner-managed company for a director to run a director's loan account, and at the year end they generally look to declare dividends to clear out the director's loan account. The problem with directors taking money out of the company informally is there are risks that at the year end there might not be sufficient reserves to declare a dividend to clear out the director's loan account. So a director's loan account can become overdrawn. This means that the director has taken out more money of the company than he's put in. This isn't a problem if there are reserves at the year end because you can declare a dividend to clear this out. However, if there are not sufficient reserves, you cannot declare a dividend, and this director's loan account stays as overdrawn. This is then an asset of the company. So if there's an overdrawn director's loan account and the company becomes insolvent, this is an asset of the company, and this means that liquidators will look to recover this money. So the directors are going to be personally financially responsible to repay that money because it's money they've taken out of the company when there were not sufficient reserves to be able to take it. So directors are going to have to look at making a repayment with the liquidator to repay this money. There are tax implications for a director's loan account that directors need to consider. With an overdrawn director's loan account, so this is money that directors have taken out of the business, they could be liable to Section 455 tax. They really should talk to their accountant to look into these obligations. If a director's loan account is overdrawn at the year end and they do have to pay Section 455 tax, this can be repaid within 9 months if the director's loan account is cleared within that time. And directors should talk to their accountants if they realise at the year end they have got an overdrawn account, especially if they don't think they're going to be able to repay it within the 9 months. The most important thing that I think directors need to consider is to really look at their cash flow, look at their profits and loss. It's really important to talk to your accountants regularly. This is not just at year end. Quarterly reports are really important to ensure that you know where your director's loan account is, and just ensure that you've put things in place, because if you are going to have an overdrawn loan account at the year end, there are going to be tax consequences and you are going to have to look at repaying that in some way. So it's really important to keep track of that month by month or quarterly rather than waiting for the year end. If it's impossible for them to pay back and it goes into a liquidation, the first port of call for the liquidator will be to talk to them to see if there's any form of settlement. So first things they'll look if there's any assets. There isn't anything to realise. Most commonly they look at houses and property. If that isn't an option, they could look at a payment plan. So a liquidator could ask a director to fill out a statement of means. So this is looking at their income and financial position at the moment to see if there's any idea to do a repayment plan. If the director is unwilling to communicate, the worst and the final step that the liquidator could do is to look at issuing bankruptcy proceedings in a worst case scenario. Directors should look at their director's loan account on a regular basis, not just at the year end. There's a big difference between having cash in the bank and having available reserves to declare a dividend. So if the director is running their company using a director's loan account with the idea that they will clear the account out at the year end with a distributable reserve and a dividend, they need to be talking to their accountant regularly to ensure that the figures that they've got are in line with their expectations and that the reserves available are also in line with the DLA that they are accruing.